Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow, and I am really glad to have Jim Bianco back with us, Bianco Research. And Jim has been with us numerous times before, a great database, great comments, and you'll be able to take his service and look at what he does. You'll see a streamer at the bottom. But Jim, thanks for being on today.
Thanks for having me, Ted.
I thought we would start from the top. You have some interesting information on the economy, sort of where we are coming back. You might give us your thoughts there.
Yeah, the big story, I think, with the economy is that earlier in the year, we had a tremendous amount of stimulus, and it's pushed the economy higher. And then the stimulus is rolled off, and the economy has started to moderate. Now, I want to be clear on the word I'm using, moderate. There's no talk here of recession. There's no talk here of slow growth. But there is talk of, let's use bad English, less fast growth. Why does that matter? Because the estimate from the Bureau of Labor Statistics is there's still about 6 million people that are still unemployed from the pandemic. And if we're not producing 500,000 or 600,000 jobs a month, it could take several years to get all of those people back to work. So we are incentivized to want to produce as fast a growth as possible to try and get a lot of those people back to work right now. And that's kind of the big issue in the market. I'm going to share my screen here with you real quick. And what you'll see here on this screen share is a chart of the reopening stocks. That's the blue chart. That's the blue chart on the top. The black chart is the S&P 500. And the green line is the ratio of reopening stocks. What are reopening stocks? That's leisure, that's travel, airlines, hotels, gaming, cruise ships, theme parks, restaurants, mall-based retailers, and etc. And the orange line is interest rates, the 10-year yield. They move together. What's driving interest rates is perception of the economy right now. It is not necessarily perceptions of inflation, although they're very important. And what you're seeing is that the reopening stocks, the green line, has been falling quite a bit since May, and so have interest rates. So when it comes to the economy, the slowing of the stimulus, the fear that the economy is slowing down, starting to show up in financial markets as well, too. And their fear that that slowing is going to become real. It's being reflected in lower bond yields.
And you had an interesting graph too, Jim, on getting back to work. I think filling the offices back up, which is probably a little surprising to most people.
Yeah, and when it comes to filling the office, that is a difficult endeavor right now for a lot of people. And this chart here, let me share my screen with you. There we go. This chart here comes from the organization Castle. They are a manager of office space around the country. And they've put together their percentage of office space currently in use. And as of August 8th, the last update we've got from them, only 32% of offices are still open in the country. That's about a third. Interestingly, the highest office occupancy right now is in Dallas, it's in Austin. Somewhere a little bit under half, around 45%. And you'll notice on the chart, too, it's dipping a little bit lower in the last few weeks as well. So we are still very, very slow to return to the office. And if I could throw in an argument about that as well, too, that argument is that I'm from Chicago. I'm coming to you from downtown Chicago. I could walk to Wrigley Field to give you a perspective of where I'm at right now. Last Sunday, the Chicago White Sox played the Chicago Cubs in Wrigley Field, and there were 41,000 people, sold-out game. The week before that, 2 weeks ago, we had Lollapalooza. There was 100,000 people in Grant Park every day for 3 days. But if you ask those same people, hey, I need you Monday morning back on the 38th floor of your office in the middle of the city. Oh, no, you're trying to kill me. You're trying to kill me. I can't go back to the office. There is a real hesitancy to return to the office. I think in addition to the economics of returning to the office, and that can be a very big deal and a big drag on the economy as we as we try to figure out what the nature of work is. Now, obviously, we're going to need a place to congregate in order to do our job, to collaborate with our employees in order to do our job. But I think it's really a question of what is that place going to be? How is that place going to work? As opposed to let's all pretend it's 2019 and go back to it. And the Castle data, which we just showed, reflects that there's a big slowing in that part of getting back to normal, is getting back to the office. Last thought for you. We're talking about 30% of the jobs in America. We're not talking about all the jobs. You know, a surgeon, a policeman, a waitress, they have to go to somewhere to do their job. They cannot do their job in remotely or work from home. About 30% of the jobs are eligible to do some kind of remote work from home.
And if you look, Jim, at that graph again, I've noticed the dip at the end. Is that with this last COVID flare-up? I mean, you think that's what that is?
Yeah, I think that that's exactly what that is. The COVID flare-up that we've been seeing lately has really been spiking. We're up a month ago, July 5th, we were at somewhere at around 12,000 cases a day in the United States, over a 7-day average. Today, as we're talking, we're at 140,000 cases a day. COVID has got people concerned. And the one thing to keep in mind about COVID is there's two issues you have to say. When you say rising COVID cases, I know a lot of people will say to me, yes, but hospitalization's down, the treatments are better, a lot of people have been vaccinated, even if vaccinated, even if you get the disease, it's much less. If you get vaccinated, all of that is true. But when it comes to the decision about restrictions on the economy, delaying the reopening of the office and et cetera, wearing masks in public places, whether or not kids are going to go back to school in September, all those decisions are made on the number of cases. They're not made on all of those other factors. I think that's unfortunate. Those other factors should play a higher weighting in the decision. But the decision to send your kids back to school, whether they're going to wear masks, whether your office is going to reopen, I think is unfortunately driven by the case count, and the case count is rising right now. And the fear in the economy is restrictions. I'm not going to say lockdowns. That's an extreme form. But restrictions, like you need to show vaccine proof to go to a restaurant or something like that. Look, New York City, half the people have been vaccinated. So if you're a New York City restaurateur, you've just lost half your potential audience starting September 15th if they have to show proof of vaccination.
So are you saying that the deaths are lower, but the cases are still higher? Is that?
Yeah. The deaths are lower, the treatments are better. If you get sick and you were vaccinated, it's less. All of that, I believe, is true because that's what the data shows. And unfortunately, not enough people seem to be taking that into consideration in New York City. You need to be vaccinated to go to a restaurant. Wearing masks in school. I'm in Chicago, in the Chicago public schools. When they start after Labor Day, every kid, even if they're 3 years old, has to wear a mask all day long. And they said in the press release, rising case counts. None of that other stuff seemed to matter. So there is the health concerns, and then there is what drives the policy. And what drives the policy, unfortunately, is case counts. And yeah, you're seeing that in the Castle numbers too. A lot of companies are pushing off the reopening of the office or maybe scaling back on the reopening of the office. And that's why you've seen the dip down in the last few weeks.
So let me shift, if I could, because you've had a lot of information over the last 2 or 3 months on inflation, and you have a few charts of yours of your database that shed some light on that. But you might give us your thoughts on where we are with CPI and PCE.
Yeah, so I'm going to use the measure of core personal consumption expenditures, or core PCE, and that's the chart you're looking at now.
I might say for which everybody out there, that's what the Fed uses. Wouldn't you say more than anything else?
Yes, and that's why I picked it. The more traditional CPI chart would look very similar to this chart, but I picked the measure that the Fed likes to look at. And you can see that it's jumped, that core PCE over the last year is risen by 3.5%. It's its highest level since April of 92, so let's call that 30 years, and it's at a 30-year high. Now, a lot of Fed officials and stuff will use a fancy term called base effect, and what that means is we're comparing June now to June of 2020. June of 2020, we were in the middle of lockdowns, everything was closed, etc. So this chart here is a 6-month annualized rate of core PCE because I wanted to remove that lockdown period from last year. So this is January through June. The annualized rate of inflation is 6.7%. That's a 38-year high. Call it a 40-year high, 4-decade high. Inflation is actually rising faster than the overall number as well, too. So you've got inflation rising. And what I like to say about inflation is it is a fact that we have inflation, and probably more inflation than most of us have seen in our careers, unless your career extends all the way back to the early 80s. The opinion is how fast will it go away? The Fed uses a fancy term called transitory, and that they think that it will go away quickly. Or there's the phrase that you could use, which is persistent, and persistent is the opposite of that. It will stick around. Now, the transitory argument is about 7% of inflation is based in what we call transitory items, used car prices, airline tickets, restaurants, that they've been reopening, and those prices have been skyrocketing as of late. And that's what's driven it up. And they refer to that as the transitory items, and they've peaked, and they're starting to come back down. But at the same time that that's been happening, we've been seeing rises in rents. We've seen rises in home prices, or what we would call shelter. So this screen I'll share here with you here. This is the CPI shelter index. Shelter includes home prices, rental prices, utilities, insurance, everything associated with a home. It's about 40% of the index, whereas all those other stuff was about 7%. It's at 4.25%. It is at the highest level since July of 2006. Now, July 2006 is the date of the high in home prices before the big collapse in the Great Recession. So that is a pretty heady number, and it's probably going to continue to move higher. The way they do home prices is they double smooth it with a 6-month average, and Fannie Mae has done some studies that they believe that this shelter inflation will not peak until maybe the first quarter. So it's going to continue to go higher. So yes, all that transitory stuff like used car prices and rental car prices and restaurants, their rise in prices will peak, and those year-over-year rates will start to come down. But shelter prices will start to go up, and I think the two meet in the middle, and that what you wind up with is continued elevated inflation or persistent inflation. Right now, Bank of America did a survey, which they actually released the day we're talking. 65% of Wall Street still thinks inflation is transitory. 32% think it's persistent. So the transitory narrative seems to have won the day, at least in the way that everybody's thinking about things. But I think ultimately, as we move into later this year and into next year, the persistent narrative will rear its head. And then that will have an effect on the markets when they start to think about something they haven't had to think about for 40 years, and that is persistent inflation.
And Jim, let me ask you, with the extension of the rent moratorium, that probably pushes out the increase a little bit further out. Maybe just your thoughts on it.
Yeah, so the eviction moratorium is trying to be extended, although some courts have struck down some parts of it, so it's in a period of flux. The first thing is, I would say it is a real burden on small landlords. You know, everybody wants to think rent, and they want to think the 40-story apartment building with 500 units, and they got a dozen or so units that these people are struggling, and that the rent moratorium will help them. That's not the reality. The reality is it's a 3-flat or a 6-flat, and they've got 1 or 2 units that are not paying, and those people are really hurting because that's a big loss of revenue for them to have those apartments without being paid. And the fear is when the rent moratorium lifts, they might start getting paid going forward, but they're not going to get anything from arrears as well too. What the rent moratorium is doing right now is twofold. It is restricting the amount of supply, especially in certain neighborhoods, because of the eviction moratorium. It's causing losses for those landlords as well too. And what's also happening at the same time is rental demand went up quite a bit. And I'll use my personal example. I have two grown adult kids that live in New York City. During the pandemic, from the summer of 21 to the spring of summer of 20 to the spring of 21, they left New York. Their rents ended in June, and they moved back home. And then they went back this spring. So all of a sudden, demand is picking up because lots of people are going back when they've had that opportunity. And I'm glad they went back in the spring, because if they tried to get those same apartments right now, the rents would be about 25% higher than when they signed their leases even 4 or 5 months ago. So you've seen a big rise in leases as well too. So the rent moratorium, I think, is very destructive for especially a lot of small landlords as well too, and it's very distortive for the market and might be reducing some supply and pushing up rents, furthering that idea that you'll get more shelter inflation and that overall inflation will stay higher than most people are anticipating.
So one last question on this, Jim. What do you think? I know you have some thoughts about this, but the big question for everybody out there is how long does inflation stay up, or does it stay up from now on? How do you see that personally? I mean, it's obviously very something hard to do, but you've got some thoughts on it, I'm sure.
Yeah. We have to start to learn that COVID's not going to go away. And we got to stop believing the promises that, if we wear masks and we get vaccinated and we socially distance, the case counts will go to zero and that will be the end of it. We're just going to have to learn to deal with it. Now, the reason I say that is this, I'm going to expand beyond the United States. There's a huge COVID surge in Asia, and they're shutting down a lot of production facilities in Asia. Toyota is shutting down a lot of car production in Japan because Japan is making all-time case highs right now. Again, driven by cases, not by deaths, not by hospitalizations, not by treatments, and not by vaccinations, but driven by cases. That is keeping the supply chain tight as well too. So that is keeping people to bid for products that they would get, say, from the Asian trade routes as well too. This is going to go on for a year or two, or this is going to go on until we realize here's COVID, here's what it means, here's the vaccine, here's your pros and cons of the vaccine, here's what you could do to protect yourself, wash your hands, stay away in certain circumstances. Now let's all go live our lives and let's all go deal with this, because there is no way, because that, although no one says it directly, they certainly imply do this, do this, do this, and then that case count will go to zero and that will be the end of it. We start to have to realize it isn't ever really going to go to zero, but it is certainly a manageable problem. But as long as we do, like the day we're talking, New Zealand, the entire country of New Zealand had one case in Auckland, one, and the whole country's in lockdown for 3 days. As long as we do stuff like that around the world, we're going to continue to have problems getting the global supply chains moving properly, and that would mean a shortage of stuff, that will mean higher prices, and that will mean inflation. When we stop overreacting to one case in an entire country, then maybe we could start getting back to normal.
So with that conversation about inflation and where we're headed, you might see how that is going to affect the bonds, the GDP and the bonds. You've got a couple of things on that as well.
Yeah, so to get deep into the weeds on the bond market, let's talk about what is the basic mover of a bond. So the orange line in this chart is the 10-year yield, and the blue bars on this chart are year-over-year changes in nominal GDP. Now, let me explain that. Nominal GDP is the inflation rate plus the real growth rate. This is how fast the economy is growing. Now, you'll see some big spikes because of COVID at the end of the chart. That's an anomaly. They'll work themselves out. But in general, some countries have interest rates like Japan that are negative. Other countries have interest rates like some of the emerging markets in 20% range. We're down in the low single digits. Why do some countries have 10, others have negative, we have 1? If you look at how fast their economy is, the total of inflation plus real growth, that should approximate where interest rates should be. So if you look at this chart, you can see in the late 70s, early 80s. Nominal growth was 10, 12%. Most of that was inflation. Interest rates were around 10, 12%. If you look pre-COVID, nominal growth was in the low single digits. Interest rates were in the low single digits as well, too. This shouldn't be a one-for-one relationship, but this is a bigger picture relationship. So if we were to get inflation, you're going to make nominal growth go higher. And if we got more real growth, you would make nominal growth go higher and interest rates would go up. Now, the funny thing about interest rates is, what if they go up? Is that good or bad? Now, I've argued it depends. It depends on why they go up. If interest rates go up because real growth is expanding, standards of living are increasing, earnings are returning, that companies are forming, entrepreneurship is thriving, real growth is expanding, it's perfectly fine if interest rates go up for the economy. If nominal growth is expanding because that inflation aspect of it, the price of everything is going up, so your dollar in a year buys you less than a dollar now, rising interest rates are problematic. So when you look at a chart of interest rates, and I'll share my screen here again with you, just to show you a chart of the 10-year yield, you can see there was a big rise in yields from August of last year, a year ago, from 50 basis points, 0.5%, to about 1.8, and it's been falling ever since. I think that what's been driving that more than anything else, again, like that reopening chart is growth. From 50 basis points a year ago, 0.5%, to 1.8%, there was a belief that the economy was going to start booming, and it did to some extent. And I think since March, and especially since May, interest rates have been trending lower because of the concern that growth is going to stumble. Again, not recession, but again, we have 6 million unemployed. We can't sit around here going with 150, 200,000 jobs a month with 2% growth. It'd take us 5 years to get everybody back to work. The hope is we will continue with this monster growth, 500,000, 600,000 jobs a month, and get everybody back to work in a year or 18 months is what we're really hoping for. And I think that the bond market is showing some doubt about that. And it's more on the growth aspects. Although I think a lot of people say, oh, look at that fall in rates. What that fall in rates means is that we are going to see lower inflation. I don't think the market is factored in inflation yet. I think it's more thinking about growth.
Jim, let me ask you one question on that. We haven't covered this before, but if you look at U.S. GDP basically on a declining curve over time and interest rates, what's to keep us from looking like Japan since 1989?
I would really hope the entrepreneurial spirit of the Americans and of American business. There's a famous statistic that The Economist magazine uses. If you look at the 20 largest electronics manufacturers in Japan, Sony, Hitachi, or Panasonic are household names that you would find on that list in 2020, and you looked at that same list in 1950, it's the same 20 companies. Maybe a couple of them have swapped positions, but a lack of really entrepreneurial spirit. Think about us. Where was Apple 10 years ago or 20 years ago or 30 years ago? Intel, as another electronics manufacturer, Cisco. We constantly have this creative destruction, the joke with Selfinger, that helps us continue to grow. And as long as we have that, and as long as we have that ideal, then the U.S. can continue to be a big growing economy and continuing to raise standards of living. We choke that entrepreneurial spirit with regulation or with rules or with actually just the belief that we can't do it. Hopefully we never get to that point. Then we become Japan. That's the biggest difference between us. They look at their electronics firms, same list from 1950, and they think stability, that's a good thing. I think most Americans look at that and go, no, it shouldn't be that way. Companies should not be on the top of the list for 70 years. They should be bending and folding, and new companies and new entrants and new ideas should always be coming in to replace the old ideas, and there should always be change. That's what makes an economy vibrant. When you don't have change, you become stagnant.
Yeah, it's interesting because Microsoft in 2000, which was in the top 10, is the only stock left today, I think, in the top 10 today, like you're talking about on the changes. The other thing I would ask you is,
Could I add?
yes,
Could I add one thing about? You're right. Microsoft was in the top 10. It's still in the top 10 today, but in the middle, Microsoft had a very rough patch.
oh yeah,
And
yeah,
that they fell way out of the top 10. They brought in Sanjay Nadella. They completely remade themselves as a cloud company, and they got back into the top 10. So the name Microsoft is still in the top 10. It's still the same stock, but the business model today is very different than the business model of 2020. Again, that vibrant change is what these companies need in order to keep things moving.
yeah. Very, very, very good point there, by the way. The last thing on that I would ask you is, obviously with the infrastructure bill and then the $3.5 trillion behind it, where are we headed here? I've had basically the opinion that we can't pay off the debt. We have too much debt to pay off. That'll never happen. Do you see us just in a bogged down mode with just more and more to keep it at that low end, interest rate wise?
Yeah, to some extent, that's true. Ernest Hemingway famously wrote in the Green Hills of Africa, how does one go bankrupt slowly, then suddenly? And believe me, I'm in Chicago, and I've been watching the slowly pace for about 20 years right now. And talk about, can't pay off the debt as well, too. And that seems to be where we're at, and we could be at that point for a long time. But the amount of debt that we've got and the amount, I think, will continue to grow and continue to grow. Now, interestingly about debt is that the supply doesn't seem to really impact interest rates. What impacts interest rates, it seems to be more demand than anything else. And the biggest drivers in the demand argument are, I think, inflation and DGT. What DGT is demographics. People are getting older. Then as they get older, their model portfolios tend to more heavily weight towards debt. So you're seeing as the baby boomers age, they're not out there buying NASDAQ 100 stocks. They're out there, buying more and more fixed income assets as they near retirement. So that's helping to hold down interest rates. Globalization, by making the world more efficient and having this global supply chain has helped to hold down inflation. Now, maybe with COVID disrupting supply chains left and right, and with tensions with China, the largest global supply partner, not just for us, but for everybody, that could be changing. But for right now, nobody thinks it is, but that's a risk. And then technology, the Amazon effect as well, too. That's been holding this down. But to your larger point, I think the federal government is going to continue to spend money crazily. They're going to continue to look at low interest rates, and they're going to continue to think, hey, it's okay, because if it wasn't, interest rates are going to go up, and continue to push on this idea that we could continue to do this more. And Ted, I'll give you a very depressing statistic. The approval of Congress runs around 13, 15%. Then they send out a stimulus bill and it pops to 30%. And then it kind of goes back down to 15%. They send out a stimulus check and it pops to 30% and it goes back down. Yeah, Congress can buy love is what it sounds like that they could do. And don't be surprised if they try to do something like that right before the 2022 election.
Well, there's that old saying by the economists back in the 1700s that once the populace realizes they can vote people in and that will give them largesse, then you're sort of stuck. And we could be there now because there's a lot of giveaways in these programs. But I want to move on to the last thing you had, which we haven't talked about this, but talk about the stock market just a little bit. I mean, it doesn't seem to have anything that affects it, no matter how bad the news is or how bad the debt is or anything else. You got any thoughts on that?
Yeah, so, you start by taking a look at the S&P 500. Interestingly, the day we're talking, we have now exactly doubled off of the March 2020 low. We did that on August 16th's close. It was exactly a double off the March 2020 low. And if you look at the chart, it's been a nice straight line up. It doesn't seem like since the pandemic in February and March of last year, not a whole lot has bothered the stock market. and it continues to go higher as we've been moving. Now, within that, to be fair, there's been tremendous rotation. Tech stocks become popular. The Cathie Wood Innovation ARC stocks had a big run into the beginning of the year. The reopening stocks had a run. Now the reopening stocks are struggling, as we showed earlier. So there's always a lot of turnover as to which themes and stocks are turning, but the market goes higher. Now, why is that? The perception about the market is that, to use the fancy term, the risk premium has been removed, because buy stocks and they'll either go up, or Jay Powell will print money and make sure that they go up. And that's what I mean by that the risk premium has been removed, is that we saw that last year during the pandemic. So people are in a more risk-taking mode, and that's why it seems like even when you get bad news, last week the University of Michigan Consumer Confidence Report fell below the COVID low to a 2011 low, and they think it's about the Delta variant. Stocks rallied. Well, why do they rally? Well, now the Fed won't taper. The Fed won't cut rates. Maybe they'll even start buying more bonds because they've got to continue to stimulate the economy. That old bad news is good news. And of course, good news is good news. So the market has been caught in that mindset for 18 months. Now, something will come along and change that mindset. It's not going to be like that forever. I don't know what. If I had to guess, it would be persistent inflation, because persistent inflation would demand that the Fed stop with the money printing, because if you don't, then you'll really see the bond market crater. But we don't have that fear of persistent inflation right now. But when we do, I think that this trend might change. But for right now, that seems to be the trend in the overall market. And again, that doesn't mean you buy anything, because if you've bought the reopening stocks, you've been struggling with them. If you rotated in May back into the tech stocks, you've been doing very well. So this sector rotation matters, but the overall trend, because of the lack of fear about the market, bull market climbs a wall of worry. Now, this bull market doesn't have much of a wall of worry to climb, and that's why it seems like it continues to go higher.
And one last thing, Jim, for the person that has new money or fresh money, with looking at the markets at the highest multiples they've ever been on earnings, and then looking at interest rates, just like you showed in the 10-year at 1.3%, it's a tough trade out there to just start from scratch right now and make money. If you've got legacy stocks and bonds, that's one thing. But if you're just coming in and starting off, we are under the impression, really for us, that you need to be more careful than you normally would be at this stage. Any thoughts on that?
Yeah, it is a difficult period to invest in, because if we're going to be honest, somebody will come into you and say, well, what's cheap? What can we buy that's cheap? And the answer is nothing. There's really not a whole lot that's cheap in this market. You have to pay up for everything. And again, it's because of that lack of risk. But this is the investing environment that we're in right now. And I do think, though, that while there will be bumps and there will be, hiccups and stuff along the way, if you believe in the entrepreneurial spirit of the American economy, which I do believe, as long as that continues, as long as we don't crush it under the boot of regulation, as long as we don't tax it to death, and sometimes I worry that we might do exactly all of those, we should, in the long run, be okay. So I would assume that your new money customers are tended to be a little bit younger. And if you are a little bit younger with a longer time horizon, get in. My adult kids that are in the mid-20s, they ask me, what should I do with my money? Get in the stock market. Well, what if there's a correction? So what? You're 40 years from retirement. You'll be very, very happy that you did that. It's a different story if you're 68 years old, because I've used to say that a bear market is time. Every time we have a bear market in stocks, the question is, how many years does it take, or months in the case of last year, does it take to recoup the losses? Well, if you're 68, you may not want to wait 10 or 12 years until you recoup the losses. If you're 28, you'll be fine if that happens and you recoup those losses in a way that you go. So, if you've got new money, I assume you're going to be on the younger end of the scale. Yeah, it's an environment where there's nothing cheap, and this is the way we work. But as long as you believe that the American economy continues to remake itself, then I think you'll be fine in the long run in order to, equities.
The way that we see it, we do a lot of work with people that have sold companies, and they are older. They're typically over 55 or 60. and they don't, they don't have time to go back and build another one, and so you have to start to take a look at it. But listen, I want to thank you so much. As usual, you have tremendous information, tremendous graphs, and as you can see on the screen here, if any of you want to take Jim's services, Bianco Research, we've given you 2 or 3 times here to take a shot at that. But Jim, we want to thank you, and listen, we look forward to having you back for sure.
Thank you. Enjoyed it.
All right, thanks a lot.